Hi everyone, it's Orlando Dallas with Keller Williams Realty, and we are going to talk about mortgage rates. Hi everyone, thanks for joining us today. What I wanted to do is help clarify the information that was given to us. As you know, the government had lowered the prime rate, but a lot of questions have come to me asking if the prime rate has also lowered mortgage rates. So I thought it would be a good idea to have Rich Manning from Summit Funding join us to help clarify that information. Hi, Rich. How are you doing?
I'm glad to help, and thanks for having me.
Yeah, I just wanted to ask you a few questions. A lot of my clients have been asking me over and over again, how do the rates look right now?
Great question. And that's one I'm fielding all the time right now. And it's one that's pretty interesting because of what's going on in our current marketplace. So, rates right now are historically still very good. But before coronavirus came out, rates were great. I mean, we're talking, I was quoting 3.25% on a 30-year fixed mortgage. Um, and then when we started becoming isolated, when we started having more of this, more of the issues with surrounding Corona, and then on top of the Dow Jones started really dropping like a rock, rates started to go up. We had talked about before is that in a matter of days, because of those low interest rates, there was $800 billion of refinance loans that came in all of a sudden. Okay. Now, when you look at that in context with the industry did 450 billion in all of last year nationwide. So that's basically over double of the amount of loans in a short period of time.
Wow.
So that crush of new refinance loans really, one, is bogged the system down, but two, is the ability to actually fulfill those promises started
Right.
coming up. So rates obviously started going up for that reason, is that the lenders, their only alternative is to raise interest rates artificially to slow the tide down, as well as with the Dow dropping, the 10-year treasury dropped. The 30-year mortgage bond became more specific about what is exactly controlling interest rates, long-term interest rates.
Okay.
Those investors want their money, and the only way that they can make their predictions on how much money they'll get out of it is to look 60 to 90 days out, and we can't do that right now.
Okay. So people like us, we don't have access to the rate sheets that you do. So as a normal consumer, what things or what sources of information can we research in order to see how the rates look?
Well,
Uh,
I always say I'd love to, I always like to help. So you can always call me at any time. I'll
okay,
be
great.
happy to share that information. But anywhere on the internet, I mean, a lot of lenders post their rates, okay? And you can see over the course of a few days how their rates change, all right? What I caution you on is that most interest rates, let's take Quicken just for an example. Quicken always advertises what their lowest rate is. It isn't necessarily a 30-year fixed mortgage, but it isn't until you look at the fine print that you start seeing, okay, they're saying, yeah, we have rates at 3%, but they're charging 2 points to get to that 3%. So in general, if you're just doing general research, that's looking at those types of lender sheets or interest rate blasts can kind of watch the direction over the course of 3 to 5 days. You'll see what's happening.
Okay, so me as a normal consumer, don't believe exactly what the lowest rates are online. You would have to process your information first to get an accurate rate. Just like a car dealership, a car may be shown in the front of the dealership with the lowest price, but once you go through those doors, the price may go up. It's kind of the same thing. It's based on your credit. It's based on your loan situation. So the best thing or best advice then would be, of course, to contact Rich and see what kind of rate you're looking at. Would you agree?
Absolutely, yeah. Every loan is different. Everybody has different characteristics, and I use the four pillars:
Right.
income, credit, assets, and property. So if
Okay.
we're not doing refinance, we don't really have to worry about the property. But those are the four pillars that we use for qualification. But like I said, everybody's loan is different.
Okay. There's also a lot of hype about the prime rate. They're saying that the prime rate has dropped or almost to zero, is what I'm hearing. And they're saying that there's I guess rumors saying that it's tied. Mortgage rates are tied to the prime rate. Is that true?
It is and it isn't, and so that's a great question, and even we have to look at really closely what the prime rate actually means. So a prime rate is actually more set up for credit cards, short-term type of financing. It evolves into the mortgage side when you start talking about second lines of credit, second loans, home equity lines of credit, those sorts of things. The prime rate is more tied to those types of loans. Prime rate is short term loans. Long term, you're starting to talk about, like I just said before, the 30-year mortgage bond. Anything that's 30 years or more, 20 years, 15 years out is more tied to those types of situations, not so much the prime rate. But the prime rate does, because of the way it evolves, does have a little bit to do with our long-term rates, not a lot.
Okay. So something like a HELOC, a home equity line of credit, is something that you could use to withdraw money from your home if you want it in the short run. Because from what I understand, HELOCs are tied to the prime rate.
That's
Is
correct.
that okay?
Mhm.
Now, I've heard of clients using that money to purchase something or probably upgrade their house, add a pool. But would you suggest a HELOC, or would you just suggest doing a refinance of the home?
It depends on what the market is dictating right now, or at any point in which you're trying to make that decision. Um, a second HELOC is good when it's definitely going to stay short term. So you're going to have, out of a HELOC, you may have a 10-year amortization or a 15-year amortization. Um, the first 5 years may be interest only. So in a course where the market is on a downturn and is going to stay down, if you can pay that money back quickly, then that is a good option for you. If it's something that you need to spread out more to have less of an impact to your monthly budget, cash out refinance is best. And again, it depends on when you catch the market. If you can catch it at an interest rate that's lower than probably what your current rate is, or an interest rate that pays over time, that sets you up over time, it's really good. I'll use a personal example is that I'm doing a refinance myself for my son that's going to college next year. I can pull $60,000 out of my home to pay for his education over the next 4 years. It cost me $250 a month, period.
Wow.
So a HELOC payment is going to be a little bit more than that over a short term, but I'm going to spread it out over 30 years and take care of his student loans or his education and
Right.
not have to take student loans.
Yes. And as you know, student loans may take a huge impact on someone's ability to purchase a house.
Correct.
Yeah.
Correct.
So, okay. Well, I appreciate the information. That was very helpful. And I'm sure that my clients will find this information handy as well.
I'm glad
So,
to be a help.
all right. Well, thank you, coach. Let's do an air high five.
Absolutely.
I'm going to go ahead and leave Rich's information up here in case you need to get a hold of him. Go ahead and screenshot it if you need to. Thank you again, Rich. Have a great day.
Absolutely.